and a joint venture, which is where the parties have a share of the net assets and the outcome of the arrangement. And the real difference here is that, well, for a joint operation, you recognise your share of assets and liabilities, but for a joint venture, there'll be equity accounting, and which means that there will no longer be any proportionate consolidation. So the real difference here is going to be for companies that might have previously had a jointly controlled entity and have been proportionately consolidating, they'll no longer be able to do that. And so that will have a significant impact on the way your balance sheet is presented and the way your income statement is presented. And you might think, okay, well, fine, maybe I'll end up with the same net number down the bottom. But the things that you'll need to think about are, do I have a range of debt covenants that might be focused on a particular line item in the income statement or the balance sheet that I now need to revisit? Do I have incentive arrangements in place for my key management that are based on particular line items in the income statement or particular results that I now need to go and revisit? And one of the biggest challenges that we've seen in implementing this new standard is some of these arrangements have been around for a very, very long time. And so we've found a number of companies actually find it challenging to find the original joint venture arrangement or agreement that might have been written 30 years ago, because of the fact that this standard is really focused on what the rights and obligations are rather than just what the legal structure looks like. So if you haven't started looking at this one yet, and you do have in your organisation and your clients have joint arrangements, I'd suggest go start digging out some of those old contracts, because you might well find that the way that you have been accounting for it is going to change. And finally, as with whenever you get a whole suite of new standards, there always comes a whole range of new disclosures. Unfortunately, I don't think the ISB is as good as they could be in trying to eliminate some disclosures at the same time that they introduce new ones. But probably the key ones to focus on here are disclosures around the significant judgments that you've made in determining whether or not you should be controlling or consolidating an entity, or whether something is a joint venture or a joint operation. So there's a number of disclosures there around your significant judgments, and again, this is something ASIC always focuses on as well. So as I mentioned before, the ISB has approved a exemption for investment entities to the consolidation standard, and the local standard setter here has decided that whilst they might permit the exemption to apply, they are putting out an exposure draft which would require companies to put in additional disclosure about what their balance sheet would look like, or what their three primary statements would look like as if they consolidated. So to my mind, that sounds a little bit like companies would need to continue to consolidate even if it were just for disclosure purposes. So the Accounting Standards Board here is going to put out an exposure draft within the next month or so, I think. They'll have probably a 120-day comment period on that. And so it's unlikely that any investment entities here in Australia would be able to take advantage of the ISB's exemption until well into next year, probably 2014. So that one's for you to watch, particularly if you work in the investment management industry. So keep up to date on that one. And the final standard that really will apply for 2013 is a new one on fair value measurement. Now, the good news here is that this doesn't really change anything in terms of what people are doing. What this standard has done is brought together all of the guidance that sat in other accounting standards about fair value measurement and put it all into one place. So in some respects, it's quite helpful. There are a couple of small changes within there. But the other thing it does do is introduce a number, again, of new disclosures. So I do feel like we quite often talk about the new disclosures that are introduced. So what the disclosures do, if you're familiar with the disclosures for financial instruments on the fair value hierarchy, then this introduces those similar disclosures for assets other than financial instruments. So what we might do now is just, I guess, finish up with talking about what are some of the other changes on the horizon. And this is often where I think of the phrase, are we there yet? In terms of this presentation, almost, but in terms of these three accounting standards, really not yet. So, as I said, these are the three main topics, other than insurance contracts, that have been on the agenda of the ISB. The first one here on revenue recognition. I guess the challenge with this one is this is part of the convergence project with the US, so trying to align or closely align as possible the guidance in IFRS and US GAAP. Now under IFRS we had, I think, we've got two accounting standards dealing with revenue and probably there's three or four interpretations. In the US, there's something like 200 odd pieces of accounting literature dealing with revenue. So it's really no wonder that it's taken quite some time to get the two boards to agree to the principles used for revenue recognition. Now, the main, this has been going for about 5 years. There's been a discussion paper and there's been 2 exposure drafts. And the good thing in this is that the principles in the new standard haven't changed since they brought out the discussion paper. So if you've kept up to date with that or you're familiar with that, there's really 5 key steps here to recognising revenue. And in my mind, these ones, they're fairly straightforward. It's more the devil in the detail. You know, first of all, you've got a contract with a customer. You need to identify what performance obligations you've got under that contract. You work out what your transaction price is, allocate it to each of those performance obligations, and then recognise it as revenue when you've delivered on those performance obligations. So conceptually, quite straightforward. But as I said, there is quite a bit of devil in the detail. The ISB, it sounds like they will be debating it probably for another 6 months. They're hoping to have a final standard out by mid-next year, which probably means that it won't be applicable here in Australia until perhaps 2016 or even 2017. And the reason for the long lead time is normally the ISB tries to give companies at least a year, first of all, after the standards approved, to get their systems and processes in place to apply the standard. And then most companies will have at least 1 year of comparatives, and some companies will have 2 years of comparatives. So what they want to do is get a standard out and then give company time to rectify their processes, to capture new information, because most of this will be retrospective, which means companies will need to restate all their comparative information as well. So the other standard that we do keep saying, are we there yet, on is leasing. And this one has had about as many twists and turns as a water slide. So the overarching principle here in leasing is, there's a famous quote here from the old chairman of the ISB, and he had once been heard to say, well, before the end of his term as chair of the ISB, he wanted to fly on an aircraft that was on someone's balance sheet. And he finished up probably 12 or so months ago now, after 10 years in as the chair, I think, and we still haven't got a standard yet. So where are they at the moment? They are hoping to put another exposure draft out next year in March, but they still haven't thought about an effective date yet. So my guess would be past 2016, 17, maybe 18. So where have they got to so far? There's been a lot of concessions made from the first draft. So I think the first idea was that all leases would be bought on balance sheet, whether they were finance or operating under our current literature. All leases would have an asset and a liability associated with it, and essentially you'd follow the finance lease accounting that we've got now. So there was quite a bit of opposition to that. So the compromise that they've got to at the moment is, well, any leases that are short-term, so less than 12 months, then they don't need to be brought onto balance sheet, and you'll recognise that just as a straight line expense. Then, if you do have more than 12 months, then you need to bring them on balance sheet. But then there will be 2 options, and maybe they're not options, but there'll be 2 ways of then accounting for that lease. If the lease means that you consume a substantial part of the life of that asset, then you follow essentially what is finance lease accounting. If it consumes an insubstantial part of the life of that asset, so here we're going to predominantly be talking about leases on land and buildings, then you can follow a method that will get to more of a straight line approach. So that, I guess, is the halfway house that the ISB has tried to get to. And finally, financial instruments. We have talked about a couple of these pieces already this afternoon. So, as I said, we're waiting for the hedging proposals to be approved, and we're hoping that that will be in the next three months. There is also a new impairment model being discussed, and given it's Friday afternoon and 3 o'clock, I probably won't go through the detail of all of that. But there is, I don't think we'll have an exposure draft by the end of this year for Christmas, but perhaps we'll have in the early new year. And the real change there is, at the moment, our impairment model under IFRS is based on an incurred loss model, so you need objective evidence that there has been an impairment before you can book a loss, whereas the proposed approach will move to more of an expected loss model, so looking at what your expectations are around loss on a particular asset. And then finally, there'll also be some changes in relation to classification and measurement. We've seen already some of that in the area of financial assets and liabilities, but there's some further changes proposed there too. So these are the slides you can take a look at home. Okay, so I know that was a bit of a wild ride through accounting standards, and there's quite a lot going on there. As I said, I think the key thing for me is around preparation. There's a lot coming down the pipeline, not too much for you to deal with right now in terms of your financial reports for December and June, but certainly lots of plotting and planning to do within your organisations to make sure you're ready for not only the standards that are coming in next year, but also understanding what the impact is of some of these other ones coming down the line on leasing and financial instruments. So with that, thank you very much for your attention. I know it's challenging after lunch on a Friday afternoon, so I don't think I've seen anyone fall asleep, but thank you very much. I'm happy to take, happy to take questions, but I am conscious of time, so I will be here for the afternoon tea if you'd like to come and talk to me separately as well.
I think we can afford to have a couple of questions here, if there are.
Yeah.
Yep, Yogesh.
Yogesh Rajput from BIS Industries. I just have a question actually. In terms of the joint arrangements and the definitions around about control, would things like debt equity classifications actually that you adopt for various other particular measures like tax or something like that, would that be actually taken into consideration for the purpose of actually defining your particular consolidation and other particular measures?
So is your question, if you, rather than having an equity interest in an investee, you might have there's a debt arrangement instead? Yeah.
It's something like a working capital loan, but which is not recalled. It's pretty much been there for a long period of time. And would those kind of things actually trigger consolidation kind of things as well?
I mean, I think you will need to think about all the financial arrangements between the investor and the investee to work through then to what extent do they influence power, the variable returns, and that's another aspect that would come in, is depending on how loan agreements are structured between entities, if that actually creates some exposure to variable returns, then that would need to be thought about as well.
Yeah, that's what I see actually. There's a bit of subjectivity in the new standard that's coming up. Thanks a lot.
Yeah.
Roshan has a question. Roshan, you have a good voice, man. Go for it.
Thanks, Farooq, for your presentation. I just have a question on the leasing reforms which you just mentioned. How would that impact in a retail organization who is leasing a lot of stores, and how the expenditure would be accounted for when these reforms come in place? Yeah,
and in fact, the where they've got to on this, a lot of that has very much been influenced by not the retail industry, but also Australia in particular, because I think Australia is a little bit different to other jurisdictions in that, yes, there's lots of retail leases. So in that scenario there, I think most leases are going to be more than 12 months, so you still will need to bring them on balance sheet. But in those cases, you may well, I think you'll probably fall into that category of using an not substantial or insubstantial portion of the asset, because you will only be having it for I guess it depends on what the term of your lease is. But
Let's say if it is for 3 to 5 years.
yeah, so you still will end up, so in those cases, you still will end up recognising an asset and a liability, but rather than accounting it for as a finance lease, which would result in some greater, so the real thing here is if it's accounted for as a finance lease, you end up with more upfront expense because you're recognising interest expense and you're also recognising depreciation or amortisation of the asset. Now, in the option that the ISB are considering, they'll say, well, you could still actually straight line the expense. So you end up with a similar scenario in terms of P&L profile, so you don't end up with the front loading of expense, you end up with a more straight line expense.
Thank you.
But it still comes on balance sheet.
Okay.
Yeah.
It's just a last question there from Vinod.
We're talking about hedging. What about the effectiveness testing? So do you still need to do the effectiveness testing?
Yes, so so the question was, will there still be effectiveness testing? So the answer is yes, there will still be effectiveness testing. At the moment, we do retrospective and prospective, and we have this band that it needs to be between 80 and 125% effective. Now, the way the new rules will work will be, well, even if you're, well, first of all, there'll be less retrospective effectiveness testing to be done, and it will be more just prospective effectiveness. And then sometimes you won't actually have to do the detailed calculations. You can just say, my terms match here, so I'll assume it's effective. So that will be simpler. So I think less calculations, and even though you might have ineffectiveness, you can still achieve hedge account. You'll still be able to achieve hedge accounting.
Thank you.
Yeah.
And just one more question on the lease. You can always have a 12-month lease, but with an extension clause for. So what is that lease going to be?
Yeah. I think you'll probably still end up being long-term, because it's about what the maximum period of the lease is. And so I think if your lease was written that you had a 12-month lease with a 4-year extension, then the maximum period of that lease is 5 years.
Okay.
Yeah.
Thank you.
Yeah. Okay. You're welcome.
If you just just get us. Yeah. Thank you very much, Margot. That was really interesting, especially considering, as you rightly said, the session after lunch is not easy at all. But I think you did a marvelous job keeping everyone awake with those examples and practical illustrations. So thank you very much, Margot. So thank you very much. Can I invite on stage Mr. Shaji from Risk Wisdom to give away a small token of appreciation to Margot. Also would like to get our Vice Chairman, Mukesh Jani, on stage as well, if you can. Thank you. Thank you. Thanks. Oh yeah, sure. So just on our sponsor, Risk Wisdom, they specialize in personal insurance, business insurance, and customized risk solutions. And again, thank you all the sponsors. So I hope you still remember the consultation paper. You can give feedback on that by 5th of December. The email ID is there on the piece of paper that was given to you along with the souvenir. So just talking about the souvenir now, I mean, the souvenir again is there in that bag sponsored by BAQ. Hope you've had a look at it. It talks about ICAI, the Australian chapter, when it was founded in 2007. What are the different activities that we held in the last 12 months? The sponsors' information, and this lots more. So to do all that, what we can do is we can actually go for a afternoon tea break while you get an opportunity to have a look at the souvenir. So how about we meet in this ballroom back at 3:35 maybe? That sounds good? Okay, cool. Cheers. Thanks very much.